Hey guys, here you have a list of questions that'll be asked during the interview. You'll notice a red timestamp next to some of those questions. That's just so that in case you want to skip to any specific section of questions, you have a reference point to go off of. Okay, I hope you enjoy. Hey guys, it's Nosh here. So today we're going to be doing an interview. Now, I have the distinct pleasure of interviewing my dad, and I'm very honored to be in this position. Throughout my entire life, particularly my adult years, I've had the fortunate pleasure of being introduced to investing in the real estate world through the significant amount of wealth and knowledge that you carry and you possess. And so this video is designed to share some of that knowledge and experience that I had the pleasure of being rewarded with you guys as the viewers, so that you too can perhaps get a head start. So without any further ado, Dinyar Panthakee.
Yeah, thanks for the honor and the privilege of inviting me and talking about what I've been doing all along in my lifetime. And my career goes back, considering my age, more than 50 years ago, when I first started out as a young lad in London, England, and I left India to pursue my chartered accountancy, which I did over there for over 4 years. And then after graduation, I worked in London for 3 years, and then migrated to Toronto in Canada, where I worked for several years before I was transferred over to Jakarta, Indonesia, and worked there for 6 years before moving on to Singapore in the year 2000, where I worked until I retired in 2016. So I had a good 50-year run as far as working was concerned in my lifetime.
So just to go over that, you worked essentially in Toronto. You also worked as a chartered accountant overseas in Indonesia, as well as Singapore. Is that right?
That is correct.
Okay. Now, what type of accounting? Like, just a brief example. Was it taxes? Was it taxes for companies? Was it just bookkeeping in that respect, or how? Just a brief summary on that.
Yes, okay. So accounting takes two types of paths. One is you're working in the CPA office, and you are auditing clients, or you're advising them on tax matters. So that's one field of it. And some of them then move on from working for an accounting firm like the Big Five, like Pricewaterhouse or KPMG, and then they move into the industry sector. And in the industry, you are doing more financial accounting, and over there again, there's a lot of branches that you can specialize in the industry, and the kind of work that you do over there is finance management, audit, treasury, mergers and acquisitions, making sure that the systems are working perfectly. So you might get more into information technology, seeing that your systems are primed for efficiency, that you basically taking out inefficiency that's in the system. And that's basically where I spend most of my time, and I specialized on that part of it. But you also keep abreast with the changes on a personal level, keep abreast with changes in the tax structures that are there, because it affects how we do our personal investment. So you manage on both sides of the coin, so to speak.
So your first home essentially was a principal residence. Was it a condo unit? Was it a townhouse or single family?
Was a single family residence, and this goes back, I guess it was 1982, and condominiums basically had not taken off in Toronto. Uh, there were just one or two buildings that came up, I remember, in downtown Toronto, and people were not accepting living in high-rise buildings as a way of life. It was just not acceptable, and people always put their money into single-family residences, which is what I followed through, and I did that. It had obviously its advantages in having more space, and you could do more things in a home that you otherwise would not have been able to do in a condominium. And there were tax savings in those days. We used to call them home ownership savings plan, whereby you could put away some money into a tax sheltered investment vehicle provided by the government, and you could use those proceeds to put towards the down payment on the purchase of a home, the first home. And being a first buyer, I mean, I had the advantage of taking that into consideration.
So now, who got you into real estate? When, for example, and how did you determine that investing into real estate was going to be your wealth building strategy?
Well, when I was in London, when I first arrived over there, and I stayed with a gentleman, and I rented a room in his home. You call them bed sitters, and that gentleman had just recently bought his first real estate investment, and he was telling me that real estate investment is a good way to go, and maybe I should also consider and buying a property in London, and I could rent it out. But of course, I mean, I was not making much money to be able to save up to buy a property. But I listened to him very carefully, and his friends that were there, all of them had individual properties. Mind you, they were their principal residents, but they were renting out a piece of their home, usually one bedroom or two bedrooms, depending on how much that they want to keep for themselves. And the income from there was sufficient to pay for the mortgage of the property. So they were basically almost living mortgage free in a sense that the mortgage was covered through rental income. So that intrigued my fantasy in getting into real estate. And then when I migrated into Canada and I had started making some money, I started putting money away towards eventually buying my first home, which I finally did after I got married, and then bought my first principal residence.
So let me ask you, you invest into real estate as well as the stock market, is that correct?
That is correct.
Why not pick one? Why not just stick with real estate, or why not just stick with the stock market and devote 120% of your time and effort and money and skill into that specific? Why would it be a good strategy, or is it a good strategy in your opinion, to invest in both?
The knowledge factor was greater. One, on real estate, it was relatively a much easier thing to do. You went to the bank or to the builder, who then arranged for financing after you put down your 5%, 10% deposit, and you basically got the okay from the bank, and you had that marvelous leverage, and which is one advantage that I have seen and I've used throughout my investment career, is that the first home that I bought was for about $100,000, and all I had to come in with was $10,000 of a deposit, and I had the property to myself to enjoy, and the bank was carrying the mortgage of $90,000. So therefore, with $10,000, I mean, I quickly calculated in my mind, with $10,000, the appreciation was now on $100,000, and if the property price went up by 10%, I basically got my 10,000 deposit, so to speak, back, and I was then just playing with the bank's money. And my timing could not have been worse in buying real estate, because the real estate prices had gone up, not substantially, but quite a bit. But inflation was very high, and those were the days when normal interest rates is laughable as compared to today. The normal interest rates in those days, if you got 9% or 10% mortgage, you considered yourself quite lucky.
Wow.
But by the time I closed on the property, when I signed on it was a new home, and when I signed up for it, the interest rates were already high at 11%. But by the time 8 months passed by, I had to go with the existing interest rates, and the existing interest rates at that time were 16%. So I got into real estate, I got into a single family home with interest rates of 16%. Well, obviously that was quite a shocker, because I had budgeted for at 11%, and now I had to come up with the money to pay the monthly carrying costs, the mortgages at 16%. And I soon realized that that's not going to make me own my real estate for a substantially long period of time. But however, I mean, that interest rate at 16% was short-lived. But since I had locked myself up for a 2 or a 3 year mortgage, I had to pay 16% on that investment of $100,000 or $90,000 mortgage for 3 years. Investment is always about also about diversification. When I come back to my original point, real estate gave me the leverage in order to build up a portfolio. But then once I had a substantial number of properties under my belt, I wanted to diversify and use the leverage that I now had gained in real estate, and look at investments into the stock market. And over the years, when I started out, there was not much information available about the stock market. You had to go to a broker, and you had to sit across the table to him, and he would suggest investments in certain stocks. And back in the early 80s and 90s, the major investment thesis in Canada used to be mining stocks. You invested it in gold mines or silver mines or oil and gas properties, and there were tax shelters that were given in oil and gas sectors in the Canadian economy, and that was it. That was what you could do. You could not invest into the U.S. stock market. It was not possible. And but then things changed. The internet came along, and now you started getting a lot more information about the stock market, and you could now invest in the stock market with lower commissions. In the early days, if you had to buy 100 shares of, say, IBM, you're over and above paying for the value of the shares. Just that one transaction would cost you about $40 or $60 in commission, which is unheard of today. I mean, today there are zero commission trading houses that give you zero commission, or for a very nominal amount. So you now had the opportunity of making investment in the stock market possible, and that went well with the diversification principle that I had. That at some stage I would want to also invest in the stock market, and the opportunity I had of investing into the stock market was something through what is called DRIPs, Direct Reinvestment Plan, and a couple of brokerage houses, the largest one being ComputerShare out of United States, and I was able to pick up buy 20 or 30 high quality stocks by just investing $50 a month into each of them. And over the years, with the dividends that the companies paid, was able to create a good portfolio in the stock market. And then, of course, age carries on, and you get a little bit tired of dealing with tenants and things like that. Whereas with the stock market, you don't have that. When you're young, yes, definitely real estate, in my mind, is the way to go and build up the portfolio. But as you get towards the 50 or over, and you've done 30 years of running around with tenants and dealing with issues, you want to have a little bit more of a laid-back lifestyle, and the stock market gives you that ability of doing that.
So what would you say would be one of the biggest mistakes you made when it came to real estate investing?
Real estate investment is always a learning process. So whether you buy your first property or you're buying your sixth property, each acquisition is different. My first real investment, apart from a single home for my own purpose, was in Toronto, where I bought a condominium. The properties I got into were sort of low value, low income properties, because that's what I could afford. And so in hindsight, looking at that, while it was, you do your investment based upon your ability to get into it, but going into low value and low income housing, you get the income side of it, and you can carry the mortgage and you can make the payments, but you don't get much in terms of capital appreciation. Appreciations are always there in bigger properties, in more value property. So my thesis of investment changed over the years, that rather than going in for income properties, low income properties, I now had the sufficient capital to invest into what I would call the smallest house in the best neighborhood, rather than the biggest home in a not so good neighborhood. And so that changed my strategy into more looking at more of a long-term capital appreciation, and I could afford to maintain the property even though it was loss-making for several years, which my wife and myself had to maintain and get our own tenants, had to do our own painting, and I soon realized, it was in order to keep maintain the mortgage payments and maintain it, meant cutting back on expenses or trying to minimize our expenses. So we would go off. The condo that I had invested in was about 20 kilometers from home, and we would take our own kettle, our own tea bags, take sandwiches, our own water, and while we did the work for a day or 2 or 3 days, we never spent any money outside, and that kept the expenses down, and we were able to manage the property. I also found out very quickly that the mortgage, that the monthly deficit that was there on the property could easily be carried by me taking my own sandwiches to work, rather than spending money and eating out during the lunchtime. So the first property that you get, you have to cut back on certain expenses, and those things are possible whereby you can make things work out.
So you did all that, you got into investing, and you built your portfolio, and there was nobody really to tell you what was right, what was wrong, what was perhaps investing too aggressively or not aggressive enough?
Well, you learn by yourself in terms of how you go about doing your investments, and there are always the naysayers who would say, you're going way over your head, and you're getting into too much of real estate, and something is going to hurt you, something is going to hit you. But if you've done your math and you've done your workings, and it's extremely important to do those, and once you know that you can get into a situation where you can be cash flow positive in a few years, and you have the ability, the sustainability of maintaining that property, then you just have to close your mind to people who are trying to discourage you from getting into a real estate investment. Because in my years, I've seen the biggest creator of wealth has been through real estate. It's the real estate that gives you that edge in terms of leverage, which is the most important thing about real estate investment. But real estate is perhaps the only thesis whereby you can put 10% or 20% down payment on whatever value of the property, but you get the appreciation on the whole 100%. So the bank gives you your 80% on your $100,000 or $500,000 property, and the larger the number, the 5% or 10% appreciation on that particular value is substantial. So, you know, if a $500,000 property appreciates by 10%, you made $50,000 and you haven't even done anything. You've just taken the money from the bank, you've invested that into real estate, you manage the tenants. And hey, I mean, I can't see an investment thesis that beats that. And real estate has kept up its value throughout the years, definitely in the bigger cities, and it has its flow through. I mean, I always look at real estate investment. If it does well in Toronto and Vancouver, it's the ripple effect will be felt in other cities throughout Canada. And some cities might take longer time to get to that level, but everything is more or less proportional in relation to values that are there. Say the bigger cities of Toronto and Vancouver, then you find that appreciation in other cities. Which gets me another point, is that if you find that the property prices are too far ahead and affordable in managing the cash flow deficit in a big city, then by all means look at smaller cities, or around Toronto. You might want to look at the properties in Waterloo or Kitchener or London or Hamilton. They might be more affordable, certainly a little bit out of the way, but as compared to in Toronto, or you move into Alberta, which is what I did and later on in my investments, or you branch out into if you have the capital, you go into the next largest city for value appreciation is Vancouver. And again, I mean, if Vancouver becomes valuations are stretched, then there are other cities around Vancouver, in Coquitlam, in Kelowna, that have still again far out of the way from Vancouver, but then you can still get your foot into the real estate market if you cannot get into the Vancouver region.
Now, here's a question: if you could start over, and do things perhaps differently, knowing what you do now, what is one major thing or two major things that you would do differently? Let's say if we could rewind the clock 30 years.
If I could rewind the clock 30 years, I would have started earlier in investment in real estate, rather than waiting for 10 years after working and having a great lifestyle, spending the money, and not putting it away into real estate. In your 20s, you wanted the nightlife, and that was where the money was spent. And then you realize that, hey, I mean, it's not the streets are not all paved with honey and gold, and you have to make that honey and you have to make the gold, and that's what real estate opened my eyes to real estate. So if I had to do it again, I would probably have gotten into it earlier and taken a bit more risk in terms of getting into more real estate properties back then. then I could have had double the portfolio of investment properties than what I have today.
Okay. What qualities do you believe make up a good real estate investor? If someone's, let's say starting out, perhaps watching this channel and thinking to themselves, do I have what it takes? What qualities would you suggest you should have, need to have, want to try to acquire in order to be a successful real estate investor?
Being a successful real estate investor or any investor is your stomach for taking risks. Each one has his own risk appetite, and if you're young, you're in your 20s and you start and you fail, well, you have another 40 years of earnings to get up and keep going, and so have a better risk appetite and take more risks at an early stage in life, because as I said, real estate is all about learning, and once you get through and over and you know what works for you, how you can manage the real estate, and not feel intimidated working with tenants or working with the banks, then you're well on your way. We advisors are there to tell you that yes, it is possible. There are a lot of success stories, and you will be successful. Now, yeah, you may not do well in a property here or there, and that's what investment is. Whether you're in the real estate or in the stock market, not every single stock is going to go up. So there will be some failures, but that's part of the investment thesis. You have to be able to take the failures and enjoy the gains, and the gains will far outweigh the losses that you may have on say a certain property.
So some of the viewers watching right now haven't actually purchased their first home, haven't gotten into real estate. Perhaps they're a bit nervous. What advice can you give to them?
My advice to them is, it's the famous Nike slogan, just do it. Until I remember when I bought my first property and the real estate agent was showing us around, and her comment that she made, I still remember that 50 years later. She says, the first buyer, you got to really kick them into the property. Until you do that, until you shove them into the home, they're not going to go and buy that property. And yeah, even if it's not an investment property, even if it's your own, you're nervous about it. Can I make the payments? Because you maybe were paying $1,000 or $1,500 in rent before. Now your mortgage is $2,000, and you have taxes and you have utilities, so your financial burden is much higher. But then over a period of time, you adjust to that higher financial burden. You make things happen. And yeah, so my advice is get into it. The sooner that you get into it, the better it is going to be for you in the long term.
Now in Canada, we have what's known as the RRSP, and that's a retirement savings plan that the government of Canada has available to every Canadian citizen. What are your thoughts on the RRSP system, and would you put money into it? I know there is the first-time home buyers plan, and somebody might be thinking, should I invest into my RRSP, build up my first home buyers plan, or should I put money aside? What are your thoughts on that?
Let me say about the RRSPs are basically is a tax deferred vehicle. It's not a tax saving vehicle. It's tax deferred, meaning that at some stage in life, you got to pay the tax on what you have contributed into the RRSP and whatever the gain in value that has taken place in the RRSP. Your principal residence, on the other hand, can appreciate in value tenfold over, and you won't pay a single dollar in tax because it is your principal residence. And
that's a good point.
The most important point and advice to individuals is don't go out and try to maximize your RSP contributions so that your $5,000 or $7,000 savings in an RSP is going to give you back a $1,500 savings. but then you don't have that $7,000 set aside as a down payment towards your property. Don't don't get swayed by the banks or the financial institutions promoting RSP when you haven't got your first home. You got to get your home and get that capital gain savings for the rest of your life, uh, just through living in your own home. That's the biggest gift I think that the Canadian government has given to every citizen, is that you can live in your home tax free, and if your home appreciates sixfold, you pay no taxes when you sell it. And if your RRSP appreciates sixfold, 100% of that is taxable. So the math, I think, works out far favorably in having your own home rather than renting. The alternative to having your own home is you're going to rent. So you're going to pay that money, most of that money, in any case. So why not put that money into a property, your own real estate, your own residence, and get all that money tax-free and stop paying the rent?
So let me ask you, is real estate investing for everyone? Would you suggest that there are some people perhaps that would be in a better position renting, or perhaps putting their money into a safe stock as opposed to purchasing a property?
I think real estate investment, if you have the ability of accumulating the cash for a down payment, then it is a must to do before you can even put money into the stock market, or, as I previously talked about, RSPs. If you don't have the capital accumulated in order to make the down payment, and then you have no alternative but to rent. But whatever savings you have then is to put it into the stock market. And there are many avenues where you can put into the stock market. And if you don't have income of much means to invest, then a broad market like the Dow Jones or the S&P 500 would be a very good, safe investment. And you just put money into that, whatever you can each month, and let it accumulate over a period of years, and that'll give you a good investment return.
What would you say makes a good investment property? In the sense that, supposing you're looking at a property on one street compared to another street, how do you know one investment property is a better one compared to the other?
Well, that's a difficult one. If you're looking within the same neighborhood, then generally all the properties would be similar. I had the experience. I mean, when I bought my first property, there was a builder around that who were building a well-known builder who was then charging a premium because he was well established. And I bought it from a small builder who nobody had heard of. And I was able to get the property 20% cheaper compared to a property that was just around the corner, because it was being built by a better builder. But after 7 years, nobody goes and buys a property saying, who was the original builder for this particular property? And so I got the benefit and of having bought the property in a neighborhood where there were builders who have had higher reputation and were building the same kind of property. So you have to be a little bit more careful. Sometimes you could choose a builder of a lower quality who's not charging a premium on his properties, and you get a better value. And that happens, of course, when you're buying a new property. On an established property, you have to do your you can look at the income level that is there. All the statistics are now available. When you purchase a property, the neighborhood, the education level, the income level, the number of people in different age groups that are there. And if it's an area where there's a better level of education, more people, more families, those neighborhoods would keep up the value and maintain the value and appreciate far better than other areas where the where you have a different kind of demographics. So, so definitely look at the demographics in the area that you are investing to see which one particularly fits your lifestyle and your requirements and your investment thesis.
Now, the Trudeau government has just come up with their federal budget, and in the federal budget, the Trudeau government has announced that they want to suspend all foreign buyers from investing into Canadian real estate for the next 2 years. Do you think this is the right move to slow down the real estate market, to lower the prices, make it more affordable for Canadians? Do you think this will solve the problem?
Well, governments always look for scapegoats for their own inadequacies. The if you were to look at the research and the papers and the different analysts who have looked at the housing market, the basic problem of housing price appreciation are twofold. One is demand and supply, and number two is the interest rates. In recent years, with the pandemic, the interest rates fell to rock bottom levels. I mean, you could almost get a mortgage for nothing. And what happens when you get low interest rates? Well, there's a big influx of people, investors who want to buy the property, and they're local investors, and they want to invest into the real estate market to take advantage of low mortgage rates. They refinance their own properties, they get the money out from their own properties, and they bought properties hand over fist, which, I mean, we've always seen the bidding wars. The bidding wars are taking place not by somebody sitting in Hong Kong, China, or Russia, or wherever. They're taking place locally. I mean, they're the ones who have pushed up the price of properties. And to make it more palatable to the voters, the government says, well, we'll stop the foreigners from buying it. But in my opinion, it's not the foreigners who have pushed up the house prices.
So, as a portfolio investor, would you suggest that the more real estate you acquire, the easier acquiring real estate becomes? Or would you suggest that the more properties you buy, it actually makes it harder to accumulate more properties?
When you acquire a lot more properties, you need to have the time to manage them all. So at a certain point, you might find that it takes, if you're having an employment income or you're doing some other business and you have investments as real estate, and if you have a substantial number of these properties, managing it can become difficult. But at the same token, all your experiences come into being when you're buying your 8th, 9th, 10th, or 15th property. And the more experience that you have gained makes you a better purchaser of a real estate, and you can make decisions much faster, and that works to your advantage in closing a deal.
Now, this is a question that comes up a lot, in particular with real estate investors out there who are looking to scale up and build their portfolio. Ultimately, we all hit a wall with the debt service ratio. And this, I remember this being one of my biggest concerns. Once you hit that wall with the debt service ratio, in your opinion, how do you circumnavigate around that? How do you get around that to build up more real estate? What are some of the lending techniques that you can employ? For example, B lenders, private lenders, etc.
Yes, so if your regular scheduled banks, the big five, are basically closing their doors and saying, you know, we won't lend you any money because you're high in debt, and you find a property that you find of good value and meets your objectives, then there are always people who are willing to lend you the money. And if they find you a little bit of a higher risk profile, then you pay a higher interest rate. And if that high interest rate, you find that you can manage the property and it's going to give you a better return down the road, then you don't have another choice but to pay a higher interest rate and get that particular property from private sources, whether they're private lenders. The lawyers have clients who are there to invest their money in second mortgages, third mortgages. Of course, as you go into second, third mortgages, the interest rates go up. So you've got to be prepared to pay a higher interest rate.
Okay. Now, for somebody out there that is looking to purchase their first home, would you suggest that they approach a mortgage broker, or would you suggest that they go to their preferred bank?
Well, if a person has got good relationships with their bank, then by all means approach them. The mortgage brokers have an advantage is that they're working with two, three of all the big five commercial banks, and they get to know the lending officers. Then they get to know what it is that they're particularly looking at. They get to know what is the corporate policy in terms of issuing mortgages, how much down payment they're looking at, or which particular area that they are more happy to lend with, and that's where the skills of the mortgage broker comes in.
Okay. Now, for somebody that owns a rental property, at what point would you suggest is appropriate for them to consider raising the rents for that particular property? I know you mentioned that you had a property in Toronto with the same tenant for the past 20 years. What would you suggest would be the appropriate train of thought, assuming that there's no rent control?
The most important thing about renting is the quality of the tenant. If you have a good tenant who pays you on time, who's never missed a payment, who looks after the property well, that in itself is worth something. And trying to go after the last dollar, in my mind, is a foolish exercise. If you raise rents which are right at the market level, that means that tenant could possibly look and get a better property, which in his opinion, or in his or her opinion, and move on. And now you have to get that property back into the market. You could lose 1 or 2 months of rent. You have to redo the property. You have to paint, or you may have to change the carpet or the flooring, or you may have to get new appliances in order to attract a new tenant. So, and that's a substantial cost in doing that. So to going after an extra $50 or $75 of rent, in my mind, is not worth the effort and the hassle, and particularly if you have substantial properties. It's not going to really make you that much more richer by having another $50 in your pocket every month.
Mm-hmm. How long would you suggest is a good time frame for receiving 100% return on your investment? Supposing you put X amount of dollars down into a down payment in a rental property, what would be a good time frame to receive your deposit back in terms of your return on your investment?
Well, the time frame, of course, is if you're looking in stocks, is the dividend that the stock issues, or in terms of real estate, what is the growth? I use a formula of 72. So whereby you take the 72 divided by the expected growth. So if you're expecting a growth of 6% a year, so 72 divided by 6 would give you 12. So you know that you would double your money in 12 years time. And somebody might think, well, okay, 6%, but if it's 8%, 9%, well, there's only a 1 or 2% differential. But that adds up to substantial doubling over your lifetime. So if you have a 6% return and you have an 8% return, an 8% return will double your money in 9 years versus the 12 years. And if you look at your life horizon, you may have, if it's doubling your money in 8 years, you may have 5 times the opportunity of doubling your money versus 4 times. And if you do the math, that's a substantial difference when you have a compounding effect over your lifetime of an 8% return versus a 6% return. So don't think that the 1% or 2% doesn't matter. It matters a lot over a lifetime. It may not matter a lot in 1 year, but certainly over a 40-year period, it's a substantial return.
That's a very good point. Supposing you receive $2,000 per month in positive cash flow, what would be the best way to maximize that money? Like, where can you put that money in terms of an investment vehicle that you, in your opinion, would be ideal?
Well, if you haven't maxed out in terms of number of properties and you're looking and you just had your first investment property, I would definitely look at that in accumulating a savings over 3 or 4 years and using that as a down payment on your second property. Like I said, I mean, the greatest thing about real estate is leverage. You put 10%, 20% down, and you have leverage over the rest of 80% over the lifetime of that property. And I would use that money to invest in more properties rather than to pay down the mortgage on the first property. Because if your cash flow carries it, you don't have to worry about that property. You accumulate the savings and move on and buying your second property, and then you just rinse and repeat. Again, you save it up and you buy your third property.
Very good. When you're investing into real estate, of course, mistakes are going to happen, and one of those mistakes, we try to avoid it as much as possible, but at some point, it is possible you'll run across purchasing a property that underperforms. And now when you come across a rental property or a property that underperforms, when do you decide to draw the line? When do you decide to cut your losses and say, I'm just going to sell this obviously at a loss, but I need to walk away? What goes through one's mind when determining this is it, I need to look for a way out?
Well, if you're constantly having problems with a certain property, whether it is you're not able to get a good tenant in that property because maybe the location is not as good as you thought it was, or that location has gone more uglier than originally you thought, and it's degraded in that particular area. That's the time when you have to really pull up the stops and saying, a simple phrase is that if you're in a hole, don't keep digging. I mean, the hole is only going to get bigger, and you just have to realize that it's a situation where you can't get yourself out, and so you just have to cut your losses. It could be because of tenant quality, or the building may have problems. The basement gets flooded and constant leakage, and even though you may have plugged the leakage in the basement, it pops up somewhere else in another year. That's the time when you're saying, okay, enough is enough. I'll have to get out of this particular one.
Now, a lot of us, obviously don't have $1 million cash in hand, but I think the mentality of what to do with the money, assuming we came across $1 million, puts us in a right mind frame on how to look at real estate and how to think about real estate on another level. So my question to this would be, assuming someone came up with $1 million cash, let's say they won it in the 649, and they wanted to invest into real estate, what would be your suggestion? Should they dump it all into one property, or how would you suggest they go about it?
Well, if you had $1 million, that means you could buy a property for $500,000, and you put just 20% down. So you're putting $100,000 into a $500,000 property. You got $1 million, that gives you an opportunity of buying 10 properties, and you now have access to a growth potential of $5 million. And if the $5 million goes up by 5% every year, you're adding another $250,000 into your capital.
Wow.
So, you know, it doesn't take too long to add up and the math to work in your favor.
That's amazing. That's a really good point. Now, there's a lot of talk about inheritance, specifically because our generation in the next 15, 25 years, you know, we're going to see a lot of transfer of wealth from the baby boomers generation into the Gen X or millennials. What would be your suggestion to those who perhaps are watching and at some stage come across a property that they inherit? What would be your suggestion in terms of what to do with that property? Should they consider moving into that property? Should they consider refinancing that property, selling it, renting it, etc.?
Well, if somebody's inheriting a property, and I'm assuming that it's fully paid up, and you're inheriting a property that's worth $1 million, it comes back again to the same thing. I mean, you've suddenly been given $1 million in your hand, and if you don't need to move into that property, and I would refinance that property or even sell it, because if you have inherited that, the person who passed it on has paid all the taxes. So now you've got a property that at cost value is the same as the market value, and if you sell it, you don't pay any tax on that because there's no capital gain, assuming you sell it within a very short time of having acquired it. Now you got $1 million, and yeah, I mean, then you basically you can use that leverage in buying your 5 properties or $500,000 or 10 properties by just putting $100,000 down.
Mm-hmm. So now let's talk about reverse mortgages. Perhaps just explain briefly what they are, and in your opinion, do you think that it's something somebody reaching retirement should consider, perhaps, or should they be looking at other forms of accessing cash if they need cash quick? And what might some of those forms be?
Right. So a reverse mortgage basically is where the owner of the property wants to continue to live in that property, doesn't want to sell it, because if he sells it, then he has got to move out, likes the property, likes the location where he or she has lived in that property and wants to continue to live in the property but does not have any income. So either a private person or the bank might say, okay, we basically would give you a certain amount of income every month for X number of years, 15, 20, 30 years or whatever, and so they're actually gaining some value to the original, to the buyer, so to speak. And at the end of the 20, 25 year lifespan, they would have received the full value of that particular property, taking into account prospective appreciation values of the property, taking into account the interest that they have been, rate that they are getting on that particular reverse mortgage. So it is appropriate for people who have substantial asset value but no cash, and that's a means of them getting money to manage their affairs, and they like to continue staying in their own property until they pass on.
Mm-hmm. Now, something that might come up from time to time is that you have new investors who have never purchased real estate before, and so therefore their biggest expense that they have incurred is likely to be either their student loan debt or their vehicle. Would you suggest that they paid off that car or that vehicle or that student loan prior to getting involved in real estate?
If the debt ratio is not a factor, then I would put money aside towards purchasing of a real estate property. Again, cash flow comes into being if the real estate property, the mortgage, if it's for his own personal use, principal residence, can he manage to make the mortgage payments and the payment on his car loan at the same time? If he can do that, then by all means, you don't have to rush into paying off the car loan. because the car loans will probably be paid off in 4 years or 5 years' time. And you have a head start by getting a real estate today, that you're locking in the value of the property. In 5 years' time, if the property is appreciated by 10%, then you basically have to come up with even more down payment in order to make that purchase 5 years down the road.
Mm-hmm. Absolutely. I mean, you could be looking at a different house altogether, or you could be looking at the difference between a condo or a single family home. So now that you're retired and you spent the bulk of your years working and investing, what does a typical day look like for you now? Is it, toes in the sand, sitting on a beach somewhere, or is it partaking in some further investments? What does your day look like?
Well, when you've been an investor all your life, you just can't step off from the podium and walk away from it all. And you still have investments, so you still have to manage your investments. I'm not in a position of investing any further into real estate, but just managing them and keeping that going. The other interest I have is traveling to different parts of the world. And of course, when at my age, with the children, having grown up and having grandchildren, visiting them, whichever part of the world they are in. I have a daughter and grandchildren in Vancouver. I have you in Edmonton, and I have another daughter and grandchild currently living in Kuala Lumpur. She's a teacher and travels to different parts of the world teaching with her husband. So yeah, I mean, a combination of those things very easily make me pass my time, and it's my children say that I'm probably working even more harder now than I was before.
I think so.
But I enjoy it. I mean, I enjoy the stock market a lot, and have done well in the last few years, and because the stock market has done well as well, and so I mean, benefited from that, and benefited from the growth in the real estate. So I don't work for money anymore, but the money keeps working for me.
And so last but not least, looking back on your investment and your career, are there any regrets? Do you feel like your money should have gone elsewhere? Could it gone elsewhere? Or do you feel like you took the right path?
Absolutely. I definitely took the right path. The wealth accumulation that you get through investment is enormous. You can't achieve that wealth accumulation by putting money into a bank deposit. You're not going to get anywhere. It was hilarious. I recently came across a Bank of Montreal email that's saying, plan for your retirement, come invest with us and save with us, and we'll give you 1.5%. Well, I mean, 1.5%, you'd have to be living for 300 years before you can think of retiring. And so I mean, to any individual starting out, my advice would be start early. And the earlier you start putting away money towards investment, particularly in real estate, which as I reiterate, it has got a fantastic leverage option. And in a principal residence, it's a tax-free gift. Take advantage of it.
Okay. Well, there you have it, guys. Thank you guys for taking the time to watch my video. I hope you liked it, and I hope you learned something. If you did, be sure to like and subscribe down below. It really helps me to grow my channel and continue putting out great content for you guys. Leave me a comment in the comment section below. I'd love to hear from you. And thanks again, Dad, for the interview and for providing the viewers with
My pleasure.
lifetime of knowledge.
My pleasure.
Thank you.